Hello, everybody. Chris Englebert with Englebert Financial Advisers in beautiful Allentown, Pennsylvania. It is the first part of June, and guess what we do every first part of the month? We go through our strategy review and what's on everybody's mind right now. I want to talk to you about the chatter that we've seen in the financial news networks lately about the bear market that the S&P 500, the NASDAQ, the Russell are in. I'm going to make some comments on that for this week's strategy update, but you can see by my cartoon, everybody's bullish on being bearish. Now, if you don't know what the vernacular means, if you're bullish on the stock market, that means you think the stock market is going to go up. If you're bearish on the stock market, that means you think the stock market's going to go down. And so far this year, with what's been happening in the averages, a lot of people are bearish on the U.S. equity market. So let's talk about the S&P 500. The S&P 500 was down sharply in the month of April, and May started off not to be much better. But guess what? We were saved by the end of May with a large, what's called a short covering rally. Now, if you again don't know what a short covering rally is, many investors bet or short stocks that they think are going to go down. And we think that this is a critical juncture to talk about, because with so many people being bearish or betting that the market's going down, there's a lot of people who are short stocks, selling stocks, betting that they are going to go down. Now, even if this is a bear market and this is a rally within a bear market, you can see some of these bear market rallies go up 15, 20, 25% in the context of a what I call structurally fair market. So what happened about the middle part of May? We had a short covering rally, say that 3 times fast, which caused the averages to accelerate on the upside about 7 to 8%. And so May was saved, and May turned out to be a slightly positive month. Well, let's talk about interest rates, because interest rates led into that short covering rally where we saw the 10-year accelerate up to 3% earlier this year, and it seemed to peak in May and is starting to come down. One of the reasons why we think it's starting to come down is we think that inflation fears are greatly overblown. Now, I know gas prices are up and I know food prices are up, but everybody's counting on that we are going to be in an 8, 9, 10% inflationary environment. We don't think that's going to happen for the rest of 2022 into 2023. We see some signs of inflation abating. Therefore, interest rates, we think, are actually not going to do too much for the rest of the year. Now, remember, the Fed controls the short end of the interest rate curve, and so the Fed is going to continue to raise short interest rates higher. But we believe that on the long end of the curve, the 10-year Treasury, we think that it does really nothing for the rest of the year. And you can see that gave some relief to the equity markets. But let's talk about some specific areas of the equity markets that we think show a lot of value, and we think it's small mid-cap stocks. Now, if you've watched some of our other videos, we've talked about the small mid-cap stock area, and we've talked about how the S&P 500 is driven by the FANG stocks, large capitalization technology stocks. We believe that money is going to come out of the FANG stocks. And again, if you don't know what the FANG stocks are, this is not a recommendation to buy or sell. Facebook, Apple, Netflix, Nvidia, Google, Amazon, those large cap tech stocks have dominated the returns of the S&P 500 over the last 8 years. We believe that trees don't grow to the sky, and that these companies are going to have a tougher time seeing their prices of their stocks accelerate on the upside. And we believe that pretty soon investors are going to realize this and look around for what's cheap out there. Well, what's cheap out there? Small mid-cap stocks. Now, if you look at this valuation chart, which is using price earnings ratios, you can see that according to JP Morgan and some of the work that we've done, that small mid-cap stocks are cheap. And remember, our thesis is that we're going back to the 1980s. In the 1980s, you had high interest rates, high inflation, and high energy prices, and small mid-cap stocks did extremely well during that period of time. We don't think that history repeats itself, but we do think it rhymes, and we see a lot of money potential to be made in the small mid-cap stock area. So let's sum up our strategy here. Again, a sharp rally in the indices saved the month of May, a slight positive for the month of May. We think there's more of this, if you want to call it a short covering rally, to continue. I can actually make the statement that I think the S&P 500 at some point before the end of the year actually goes green for the year. Is it on a short covering rally? We don't know. Or is it on a renewed optimism that the U.S. economy is not going into a recession? Some of these could be factors that cause the market rally to continue. However, we've had a sharp rally here so far, And we believe that you could see some backing and filling, but right now, the easiest path is upwards right now on the major U.S. equity indexes, and that's where we are positioning our clients. We do think that 10-year Treasuries peaked so far for the year. Maybe we go back to 3%, 3.25%, but we think longer-term interest rates have peaked. Now, what does this mean as far as your strategy goes? Again, you have to talk to your financial advisor. If you're watching this video, we are probably your financial advisor. We are making some changes to portfolios. The last month or so, we've been lengthening duration, buying longer-term bonds. We've been rotating money to small mid-cap stocks because we believe that that's where the value is. But again, don't lose sight and don't try to jump in or jump out of the market on a daily basis or get scared or panicked and go all to cash at exactly the wrong time. So that's what we have for this week. We'll be back next week. Thanks much for watching. We'll talk to you soon.